Okay, welcome, ladies and gentlemen, to another edition of Macro Ace with your host Tony, looking at Canadian inflation data. Hopefully, you can hear me. We did have some weird sound issues before where I sounded like I was on a spaceship, so hopefully, you don't get those sounds. Sounds okay to me, though, so far. So, let's get into the presentation. We've got quite a bit to cover today for Canadian inflation. So, what is it? CPI. It's the price that consumers pay for goods and services. And why is it important? So, the Bank of Canada follows the headline and core inflation readings when they're determining monetary policy. And of course, a lot of the inflation figures that we've had have been quite high and have been consecutively higher than have been consecutively rising the past three editions of the release as well. So for the Bank of Canada, it's quite a key point for them when they're deciding where to base or where to put monetary policy and how much tightening that is needed within the economy to rein in that inflation. Also the same for other central banks as well. In this current time, inflation is quite a key and a hot topic. Pardon the pun. But yes, so inflation overall being the key topic for everyone, that everyone's trying to rein in and try and find out ways to curtail that without slowing down the economy too much or causing a disruption in economic activity. So how does it affect the markets? So for the currency or the Canadian dollar, usually a high inflation reading is generally bullish for the Canadian dollar. Of course, the higher inflation is, the higher chance there is of the central bank taking a tighter monetary policy action, and that will lead to a firming up of the Canadian dollar. Of course, when interest rates are raised, that makes the Canadian dollar more attractive to foreign investors. Hence, you get a higher currency value. For bonds, a high inflation reading can lead to higher yields. But bearing in mind, of course, the reason why we see high yields is because, again, it goes back to the central bank potentially raising their rates much sooner or at a much stronger pace. That could mean that for bonds, of course, the central banks usually control the short-term end of these bonds, of these short-term securities. So when they raise interest rates, that will also raise the value of not only the short-term bonds, but will also across the curve look to increase the value of other longer-term bonds as well. Reason being, also in the government's point of view as well, when you raise interest rates and you've got more and yields are becoming more attractive, you've also got to think about from the central bank's point of view that the economy is back on the mend. So when the economy is back on the mend and there's a bit more risk taking in the markets, i.e. people look to stocks rather than safe haven assets or riskier assets, then the way to try and attract those people back to bonds or to be able to buy into government debt is to decrease the price of the bond and increase the yield that bond traders or potential traders or investors can receive for those bonds. So in this environment, at the moment, we're still seeing that bond yields are still going higher off of the back of further tightening expectations and 50 basis point hike expectations that are coming through. Again, not only in the Bank of Canada, but also you have the Federal Reserve, which we had comments from Bullard a couple of days ago saying that 75 basis, talking about 75 basis points, but saying that it's not on the table. So giving a bit of a stronger whiff of more tightening from the Federal Reserve. But the Bank of Canada, they've already hiked the rates now twice. And now we've already had a 50 basis point hike from Canada as well last week. So does that mean, or how much will the inflation data move the markets later on? Well, today we'll have a look at that and have a further discussion about it. But let's move on. So the previous report, energy and food were higher as expected. Of course, the geopolitical tensions being cited as the main reason as to why consumers are paying 32% more compared to last year for retail gasoline prices from the report. And then you also have the grocery prices continue to climb. So, of course, we've also got to bear in mind agriculture as well has also been affected from the Ukraine-Russia conflict, where it's become, well, in the market, it's become quite expensive to buy agricultural goods. So the price of foods purchased from stores was up 7.4% and rose at a faster rate year-on-year pace in February than in January, which was 6.5%. Which is the largest yearly increase since May 2009. So not only does it tell us that grocery prices and people are buying more food, but also it can, to a degree, show that consumers are more happy to spend more money, even though prices might be rising at a rapid rate. So that's one thing to kind of consider. You've got your fors and against. That yes, it's quite bad that we have. You could think of that there is a need to buy these basic goods from groceries, but it also shows that even with higher prices, consumer spending is still increasing. Again, as said, it's the largest yearly increase since May 2009. Then if we look at the triggers for today, then for the releases, so we've got the month-to-month with a high of 1.3% and with a low of 0.6%. And then we've got the year-on-year with a high estimate of 6.5% and then with a low estimate of 5.8%. So if I go back to, which let's just compare today's forecast today as well. So we're expecting the median estimate. So the median estimate, according to economists, they're expecting month-to-month data to actually go down by 0.1% to 0.9% from the prior 1%. And then the Canadian inflation data for year-on-year, that's expected to climb to 6.1% from the prior of 5.7%. So that's what the data is for today. Again, more or less quite light anyways, release wise for the rest of this week. So I think of course the Canadian data is going to get some attention today. Of course the biggest bit of attention today, as that leads to expectations for future monetary policy. But if we go back to the presentation then, so where is the economy at the moment? So inflation, as said, it's the highest since 1991, or about a 30-year high, which is the third consecutive rise, and the second consecutive second consecutive month that the inflation reading has been above 5%. So quite a hot market, quite hot inflation readings that we've been having recently. The GDP quarter-on-quarter annualized, or how much the economy is expected to grow over the rest of the year, came in at 6.7% versus a prior of 5.4%, which is better than the Bank of Canada's forecast, where they were looking at the fourth quarter to finish at around 5.8%. So overall, better than expected GDP data for Canada. In regards to their employment change, or their version of non-farm payrolls in Canada, they added 72,500 jobs in February versus 337k. So a bit of a slowdown in the net amount of jobs being added, but still jobs are being added to the economy. So the average hourly earnings at 3.7%. So you've got inflation that's still eating into consumer wages. And then the unemployment rate fell from 5.35% to 5.3%. And of course, the overnight rate, we had a 50 basis point hike as expected, which on April 13th, or as I said last week, to 1%, which is the biggest in 22 years. A reminder, the last time that we had a 50 basis point hike in Canada was back in 2000. So it was quite a significant step for the Bank of Canada. But We've also got to bear in mind some of the other things that have happened globally as well, where you've had the Reserve Bank of New Zealand, which was the first central bank out of the other major central banks to hike rates by 50 basis points. Bank of Canada's views on what they say. So Macklem, on if the bank waited too long to raise rates, he said that the war in Ukraine is the main reason for high inflation projection. Of course, the key thing for the Canadian economy is the commodity space, so crude oil and also other natural resources that will have an effect on the appreciation of the Canadian dollar's value. He also went on to say that if demand responds quickly to higher rates and inflationary pressures moderate, it may be appropriate to pause hikes once we get closer to the neutral rate. Now, usually what that does, what that can mean for the Canadian dollar, if we see that the central bank decides to hold rates, then that could mean that the value of the Canadian dollar doesn't continue to increase. And it could mean that for stocks as well. Usually, one thing I forgot to mention when we're looking at how it affects the markets. For stocks in this environment at the moment, with inflation being the big evil, let's say, to stocks, usually stocks don't see an appreciation if inflation rates go higher within a tightening cycle. Okay, and before you usually reach the neutral rate, which in the case of the Bank of Canada, which they're looking to get the overnight rate at around 2% before they consider any further action. So for stocks, it can usually be anthema, or it doesn't bode well for stocks. Of course, higher the inflation rate means higher the interest rate, and means less borrowing that is available, or less borrowing is done. And leads to less corporate profits. So that's the effect that can happen with the stock market. But again, if there's a pause, that could give some relief to stocks, and in turn could see, we'll wait till we get to around the 2% neutral rate. But it could mean that instead we see a decline in the Canadian dollar, and bond yields actually see an increase. Bond yields see a decrease and bond prices see an increase instead. Okay, the statement, so from the Bank of Canada's their last statement that we had last week. So 2022 inflation seen at 5.3% versus a prior 4.2%. 2023 seen at 2.8% versus a prior 2.3%, and 2024 seen at 2.1%. So even though the Bank of Canada's inflation target is 2%, you can see that for at least a year or nearly 2 years, inflation, it will take nearly 2 years for the inflation target or inflation to get close to the Bank of Canada's target. So if the Bank of Canada is looking at inflation to take 2 years, how long will that mean that the Bank of Canada will raise rates in order to try and rein that in? But I think they factored that in here with their projections. Even though it is higher than their previous forecast, I think they would be more satisfied if by around 2023, let's say, or towards the tail end of 2023, we get inflation to around 2.1%, meaning that they wouldn't have to take any further drastic action. So that's what the Bank of Canada is hoping. But even with but again, as said, it's clearly obvious. You can see from their forecast that they're expecting inflation to be much stronger this year. Hence, that factors into going for a 50 basis point hike rather than 25 basis point hike. So in a way, 50 basis point hike has now become the new 25 basis point hike in this current circumstance from what we've seen so far with the RBNZ and the Bank of Canada. Then if we look at other bits here as well, so they revised sharply upward their inflation outlook for inflation, again also increasing growth forecast for 2022 in anticipation of higher exports, stronger business investment, and robust consumer spending. So again, a stronger economy plays into the hand of a tighter or more hawkish central bank. And then one of the other parts of the statement saying that there is an increase in risk that expectations of elevated inflation could become entrenched, i.e., that any bits of inflation, so let's say from the Ukraine war conflict, where commodity prices have been higher overall on agricultural goods, where that could linger for much longer than the central bank would like that part of inflation to stay there for. I.e., they would look for every bit of every area of inflation to see a decrease, but of course in the real world that's not possible. Of course, you're going to get some areas that are going to be much higher than anticipated or wanted. So in this case, Bank of Canada is taking into note that there's going to be some more entrenched or some parts of the inflation reading and report that are going to linger for longer than expected. Consumer spending is expected to remain robust due to employment gains and wage gains. Consumers are also expected to draw down the elevated level of savings accumulated during the pandemic, i.e., consumers are going to be more open to spending in a healthy economy. They're going to be able to go out more and spend that money in retail stores and other goods and services as well. So investment bank views, you had BMO, Douglas Porter, chief economist at BMO, forecasting two more half-point increases in June and July, with the central bank's key rate ending 2022 at 2.25%. So near enough that neutral rate that the central bank is looking at. If we're comparing the neutral rate to other central banks, the Federal Reserve, it's more of a mixed view, but the average neutral rate that comes through is 2.4%. So yeah, there is some movement, I guess, or expectation wise. There's some correlation between the Bank of Canada and the Federal Reserve, but you've already had the Bank of Canada that's ahead of the Federal Reserve by hiking their interest rates much sooner compared to the Federal Reserve. So yeah, there's some similarities, but more so the Bank of Canada is more ahead or has been quicker to try and bring down or rein in inflation. Commerce Bank, what they mention is that the Canadian dollar is unlikely to rise considerably versus the US dollar, even if inflation data fuels bets that the Bank of Canada will raise rates at a faster pace. So what does that mean for us today? So what that could mean potentially is that if traders are expecting stronger rate hikes or tighter monetary policy, and inflation is more or less or in line with expectations or slightly higher than forecast, could we see strong moves on the Canadian dollar? That's one thing that which I'll show you and we'll go through. But I think today, from what we've seen in the past bits of data that we've had for the Canadian inflation read, if I just get it up for you guys. Okay, so the past inflation reads where there's been about a 0.3% deviation, at least in the forecast, from the forecast figure to the actual figure. So for the dollar CAD, we'd seen about if we're going back to February 16th, so prior the previous month to March 16th, we had dollar CAD, which has seen about 13.5 pips move towards the downside. Euro CAD seen about 21 pips down, and GBP CAD about 26.5 pips down. Okay, so pip wise, GBP CAD was the stronger mover, and then CAD JPY had seen about 17 pips up. So that was when we had data that was where we had seen at least a 0.3% deviation on the forecast figure. When we'd seen it was higher than expected. March 16th, although data was positive for inflation, it wasn't as strong, or there wasn't a stronger deviation compared to February's data. So we did see still some movement, but it wasn't as strong as the prior month. So we've seen about 11 pips down on the dollar CAD, and on the Euro CAD about 13.5 pips. GBP CAD seen about 13.8 pips down, and CAD JPY has seen about 10.5 pips up. So it still had a movement from the positive data, but it wasn't as strong when we had at least a 0.3 deviation. So now some economists today are looking for at least a 0.4 deviation. But from what we've seen in the past on February 16th, that even with a 0.3 deviation, we can still see some of those decent moves or a decent amount of pips on these other currency pairs. Now, when the data was in line with expectation, again, I think, so what we'd seen here, it was a similar reaction to what we'd seen in the last report, where we'd seen about 12 pips down on the dollar CAD, 15 pips down on Euro CAD, and 16.5 pips down on GP CAD. CAD JPY had seen about 10 pips up. So a less clear move when data is in line with expectation, and there's no deviation, which makes it harder to have a look at. But overall, we'd seen CAD JPY had moved up, even though data was in line with expectation, and dollar CAD had seen the expected reaction from the had seen a negative reaction or a bearish reaction to data being in line with expectations. Whereas EuroCAD and GPCAD seen the opposite. So again, it was quite mixed, quite a mixed reaction. So if we do get data that's in line with expectation today, I think we'd expect a bit more we could see some more mixed reactions in the markets and in the currency pairs as we'd seen back in January 19th. But one thing to mention as well, when we've had in the US, where we've had data in line with expectation, what has happened is that usually for stocks, they see that as a positive. The reason being, if inflation is seen to be slowing down and the central bank hasn't hiked their rates by that much, or they're at the start of their cycle, usually what that means is that for stocks, it can be positive that actually central bank or government, central banks wouldn't have to be as aggressive in their hiking of interest rates to curtail inflation or to slow down growth. So in actuality, seeing a more or less data that's in line with expectation or on the dot could be seen as more of a positive for stocks, and less positive for the currency. But again, that was in the US, what we'd seen with the prior inflation read, where data was more or less in line with expectation. And actually you had other bits of data too to support a weakening dollar, with the core CPI data coming in much lower than expected. But overall, I think we could either get some mixed market reactions today, or we could see where the Canadian dollar could see some weakening if data is in line with expectations. Again, the US had more data to look at and take in, so we could see maybe, again, not too much of a reaction today if we get data in line with expectation. That sounds like quite a bit, but hopefully that should kind of cover off the different sort of scenarios of what to expect and what we've seen in the past with other releases in other countries. Does anyone have any questions so far? Am I making sense? We've got about 7 minutes as well till the release. If you do have any questions, as always, do put a message in the chat and I'll try and go through it and answer. Scotch and Stocks says correct. Okay, lovely. Good to see you again. Thank you for your continued support. You are good. Thank you very much. Excelente. So one other bits I wanted to kind of cover off as well from Commerzbank. Now, they say that on the market that more than 75 basis points are already priced in the overnight index swap rate expectations over the 3-month horizon, i.e. the next 2 Bank of Canada meetings. So there could be 25 basis point hike at one point, and then a 50 basis point hike in one of the meetings, or more or less a 50 basis point hike in the upcoming meeting in June. oh, sorry, in May, there could be one, and then another one, another 25 basis points in the next, well, in July. So what they do say in their thoughts, they say that consequently, dollar CAD will struggle to fall significantly, even if the market increasingly expects one or more 50 basis point Bank of Canada rate rises. So again, according to Commerce Bank, that's what one of the analysts is expecting. That they're not expecting too much of a movement on the dollar CAD. FX Burr says, I did not know you guys provided live streams. Well, hell yeah, we do. We've been actually, we are working, we've recently started. So it kind of makes sense that you might not have heard of the service. We are trying to promote it as much as we can. We've started about a month ago with Macro Ace. But if you are enjoying it and you like it, then good. But as always, for our peeps, we'd want feedback on whatever we do. Sentiment as well, as said, you had the RBNZ that hiked their rates by 50 basis points rather than 25 basis points on April 13th. So again, a tighter monetary policy, a much faster action being taken by central banks to rein in inflation. That's overshot their 2% inflation target. And of course, 50 basis point hike is on the table with the Fed in May and June as well. So the expectation for, as said, stronger action being taken from different central banks. 50 basis point hike becoming the new 25 basis point hike in this current circumstance. And then also the yields as well. So the Canadian 2-year bond prices fell after the rate decision. Again, the lower the bond price is, the higher the yield becomes. So as said, recently or yesterday, you had the Canadian 2-year yield that rose to 2.5%, high since 2008. So again, tighter and quicker monetary policy action is having a stronger or more volatile effect in the market, where you'd expect stocks to still see a weakening from higher inflation reads and tighter monetary policy expectations. So the 10-year rate also increased to 2.83%, the highest since 2011. Canadian equities rose for the third straight session as a rally in oil and metals prices pushed energy and material stocks to overtake the top financial sector. Again, this is all recent, within the last couple of days or so. And then the market reactions, we got about 3 minutes, so I will play this here, and then we will... Whoops. Put on some music for you instead. Let's go through here. So... about 2 minutes. Okay. So we have the data. If I kind of... So CPI came in much better than expected, and overall, so CPI month on month at 1%, and Canadian CPI year on year of 5.7%. So you can see here, if dollar CAD had seen some movement towards the downside there. If I kind of go ahead, CAD JPY had seen some strengthening off of the back of that on the first candle. Okay. And then if we look at the other areas too, and we've got about nearly less than a minute left. But overall, what we've seen, again, you'd seen some Canadian dollar strengthening overall in the markets. More so moves in CAD JPY, what we've seen. So okay, we've got less than a minute now till the release. Okay, let's pause that there. Let's go back to, right, let's get rid of this release here. Go that up. Let's get ticks right going to. Okay. I want to get some of the other currency pairs going as well. Where are we? GBP. Let's get G going. Let's get RBNZ CAD. What? We can have a look at the New Zealand dollar today as well. And then, okay, all right, go. All right, Canadian CPI much better than expected at 1.4%, higher than the forecast of 0.9%. A CPI year on year 6.7%, higher than the expected forecast of 6.1%. So overall, seeing Canadian dollar strengthening in the market here. Euro CAD down, GP CAD down, CAD JPY up there, dollar CAD we can see again weakening. So overall, Canadian dollar strengthening. Inflation data much better than expected, and also bigger than a deviation of at least 0.3% on CPI month on month, and of course for Canadian CPI year on year, also much higher than expected as well. Oh, that's interesting. I had an alert put in for the Canadian Bank of Canada stuff, even though I don't have any data in there. Okay, so the market's reacted in the way that I'd expected to so far at the moment. Let's check the pip amounts now. I think that'll give us a more of a sign as to how strong this reaction, how strong the market reaction has been. I think probably maybe 12. No, it's about 50. It's about 20 pips. Towards the downside on dollar CAD. Oops, if I get that. Okay, so about 20 pips there on dollar CAD. Let's go to CAD JPY. Usually, actually no, GP CAD was a stronger mover previously when data was much better than expected. So I'm expecting a stronger move pip wise on GP CAD. Okay, about 22 or about 23 pips. That was the downside. CAD JPY, not seeing, well, it's not too strong of a reaction compared to the other ones, visually speaking. Okay, it's about 16 pips towards the upside. EuroCAD, that's about, seems to be about 22 pips. So GBP CAD seen the stronger move so far. I also want to look at the Aussie dollar and New Zealand dollar too. Okay. Okay, didn't see a strong reaction, so it looks to be the weakest reaction so far out of all the currency pairs, with about 15 pips, and then New Zealand dollar probably see a similar reaction of around maybe 15 pips towards the downside. Oh, whoops, it's wrong currency. Okay, so even less, about 13 pips. Okay, so the weakest reaction. So as expected, the strongest reaction was on GBP CAD with about 23 pips was the downside. We'd seen the Euro CAD with the second biggest move. And then we went dollar CAD, CAD JPY, Aussie dollar, and then the New Zealand dollar. So that's where we'd seen the biggest reactions occur, that's the biggest moves that we've seen. Again, GBP CAD taking the lead there. If we're looking at the other bits of data too, why not? So we've got the other bits of data. So the core CPI for Canada, much higher than expected compared to the prior, 5%. Core CPI month on month, 1%. So everything overall is much higher than expected in Canada for the inflation read. So I think that's also overall helping what we can see so far. And also using tick strike here, seeing some, did see some, it hasn't cleared. It's been 5 minutes and still hasn't gone back to pre-trading or pre-release levels on any of the currency pairs. Aussie dollar nearly there. GBP CAD, so GBP CAD still down, more so compared to the other currencies, as is the Euro CAD too. Okay, let's have a look at the comments now that we've gone through the release there. Bearing in mind, we do have a reminder as well for later on the EIA inventories release that will be going through the prep for you at 10 a.m. Eastern time. But one thing to remember is if you've liked this live stream that we've done and the prep that we've done for you here, then hit us up in the mailing list that you can join at that we've put in the chat there for you. Now, if you want to stay up to date with what to expect for the rest of the week and also get the live or get the replay videos of what we've done today, and then you can sign up to that and stay up to date with what we put out. Also, it'd be good for you guys to give me some feedback as well. So what you can do is you can email me at tony@financialjuice.com. And by that way, again, good to get feedback, anything that we can work on. Again, this service, it's something that we're, as I said, is quite new. Been doing it for a month. Any way that we can help make it better and a better experience for you. And also any other product ideas or any other bits of software that we bring out for you would be quite great for you to get your feedback on as well. Other than that, okay, Scotch and Stock says, don't forget to give in your tickets +1 like. I guess we're charging everyone now. FX Spurs says, and also, so yeah, don't forget to give your +1 likes, i.e., don't forget to smash that like button and also subscribe to our channel to stay up to date with everything else. Again, as said, if you love us, then show it. FX Spurs, sorry. It's quite awkward. FX Spurs says, is it needed to do this extensive analysis, or can't you just wait for the release and go bullish if it's over forecast number and bearish if it's under forecast? We could, but that doesn't help you with your understanding of the release and what to expect for. Also, the reason why we're going into a bit more detail is the more information traders know about what to expect before a release and what is currently being talked about, the better they can prepare for their trade. And the reason why I go through sentiment is, of course, in this current or in recently where we had the Ukraine-Russia conflict, where releases didn't have a market reaction, or didn't see any movement. That was one thing to bear in mind for releases, such as the EIE data that we have today, and inflation expectations, like I've gone through today as well, and where if central banks are looking to be tighter in the monetary policy, what does that mean for certain releases, like the inflation reports, like when we get the jobs data coming out for certain from the US or the Canadian economy? How do they react? Do they react differently when we have a different sentiment? So if we're in a hiking phase, if we get inflation that is better than expected, will that mean that the Canadian dollar will continue to appreciate? Or if we're out of the hiking phase, but inflation is still shown to be much higher than expected, could that mean actually that the Canadian dollar could see some weakening instead if inflation is out of control? And also for stocks as well, does that mean that that stocks lose their value the stronger inflation is, and that the stronger central banks tighten monetary policy to try and rein that in? So overall sentiment is the key thing. Macro ace, what is moving the markets mainly, is very, very important to understand, and to see and what to expect to a degree to be able to prepare for the releases that are coming up. So that's the key thing. Sentiment overall. What's happening now? How a trade is feeling about the world economy, the global economy, and what do they expect for the future as well, and how they're pricing that into the markets. I hope that makes sense to you, FX Bears. Unusual activity. Hello. Saying, have you seen the report? Lovely stream. Cheers. Thanks, James. Yeah. That's what we'll have a look at. Yeah, actually, that's one good point that we can have a little look through and peek. So, data. If we have a look, prices rose across all major components. So don't forget you have housing, energy, food, and then you also have the medical and recreational goods as well that are covered in the CPI report. So housing and also rent too. Okay, so inflation rose across all major components. Prices increased against a backdrop of price pressures in the Canadian housing market. And substantial supply constraints and geopolitical conflict, which has affected energy, commodity, and agricultural markets. Okay. So, of course, so transportation is the bigger mover in the report, or the biggest mover in the report. I think the obvious reason is, of course, with high energy prices, you're going to get transportation that is going to cost more to deliver goods across the country. Food, slightly higher. Shelter, not too much of a difference there. Household operations, furnishing equipment, did see a slightly bigger jump. Recreation, education, reading, a bigger jump there. And then, but overall, the biggest mover, transportation, recreation, food were the biggest parts there. Higher price for gasoline and fuels and other fuels. Global oil prices rose sharply in March because of supply uncertainty following Russia's invasion of Ukraine. Again, the sentiment of Russia-Ukraine is important to understand what's going on and how that's affected the report itself, bearing in mind before it's even affected the markets from the report and the data that we've seen come out today. Again, the more knowledge you have, the stronger position you are in, and the better you can prepare yourself for these economic releases that come up. per March, month-on-month price for fuel oil and other fuels rose 19 or nearly 20%, second largest increase on record after February 2000. So again, I think, yeah, it's very obvious. Higher oil prices and high commodity prices is going to lead to higher CPI reading. Okay, so that concludes that there for us with the Canadian inflation data. Reminder, we do have the EIA inventories at 10 a.m. Eastern Time, the release being at 10:30, but usually 40 minutes, 30 minutes beforehand, we'll start doing the prep. Anyone that has any other questions, don't forget to, as said, you can email me with the email that I provided in the chat. And then also sign up to a mailing list as well, as said, stay up to date. And as always, like and subscribe to our channel and stay up to date. All right, thank you very much, and see you in a little bit. Actually, before I do that, that's a very good point. Why don't I put the the next video for you up in the in the chat here, so then you don't have to find it for yourselves. There you go. All right. There it is. It is there. Okay. Take care, guys.